It's hard to ignore the challenges that are now facing the technology sector at the moment. The IPO market is suffering one of its longest droughts in 20 years as inflation erodes earnings and recession jitters strike fear into markets. So who better to help us to understand the route ahead than our next speaker, who I'm certain needs no introduction. Up next, we're joined by a defining player in global private tech investing, Orlando Bravo, and he will share his views on how the strategy for investing in technology has now changed. And Orlando will be interviewed by Financial Times journalist Kaye Wiggins, so please welcome them. Here they are.
All right. Hi, everyone. Thank you so much for joining us this afternoon. My name's Kaye Wiggins. I'm the private capital correspondent at the Financial Times, and I'm joined today by Orlando Bravo, who's one of the co-founders of Thoma Bravo. A little bit of context before we kick off. Thoma Bravo obviously specialises in software deals. It's gone from being a relatively niche firm about a decade ago or so to being a kind of giant of the industry with $112 billion under management, which is more than Blackstone had when they IPO'd in 2007, apparently. Along the way, it's bought companies or bought stakes in companies ranging from Sophos to Stamps.com to SolarWinds to Anaplan, many more as well. And this month was in the news because it decided to walk away from talks to buy Darktrace, the UK listed cybersecurity company. Orlando's also made headlines this year with his bullish views on Bitcoin and also his comments on Elon Musk's takeover of Twitter. He considered providing equity for that deal, although obviously Elon is now trying quite hard to get out of that deal. So that gives us plenty to talk about. But let's start with Thoma Bravo, shall we? Thoma Bravo has been buying companies at a kind of eye-watering pace for the last few years. I've got some numbers here on the funds that you've raised. So just the flagship funds alone, Fund 13, 12.6 billion in 2019, 14, 17.8 billion in 2020, 15, 20 billion as of May 2022, which suggests you'd already spent most of the roughly $30 billion or so in the previous two funds. So how is that kind of huge top of the market 2019 to 21 vintage looking now that the market is turning?
Yeah, well, thank you for having me, first of all. It's nice to see you. That's a way to start. This is going to be fun.
But, you know, we don't do the easy questions here,
right?
do we?
But before I start, I want to acknowledge Puerto Rico. I'm from there. I just came over to do business here, and while I was on the trip, the hurricane again devastated the island. We have an important foundation there that's doing a lot of work with all of our communities. Things are not as bad as before, but it's always very strange for me to be doing business, which I love. Like, I'm all about Thoma Bravo. I love what I do, and I'm all about the foundation as well. But they're two such different worlds. You're here to talk about deals and making money, and then people are suffering where you're from, and we deal with that. So I did want to acknowledge that.
Yeah, of course. And we should say you've, in the past, done pretty extensive assistance work with Puerto Rico, right? You chartered a plane and flew a plane out full of stocks like cereal bars in the past. So I'm remembering the bits that we wrote a couple of years ago. But you've done some pretty extensive work with.
That's what got me back to Puerto Rico, was a humanitarian effort when Hurricane Maria hit. And it's one of the hardest things I've done. And once we did that, we then have established a lot of programs there, and we spent a lot of time on the island. But talking about, you mentioned some really, really important things about investing, and you mentioned the peak of the market. The most important thing about private equity, and I know that many of you are direct practitioners in it, buying companies, is the way our industry makes money is not by timing the market. It has nothing to do with that. You buy a great business when you can. And as a business owner, the question is, what can you do with it? Our industry is not about buying high and selling higher. It's never, ever been about that. Some of our best deals were done in 2007, 2 months before Lehman went under. Highland Software being one of them. The EBITDA of Highland has gone from $30 million at the time we bought it in July 2007 to over $300 million today. And it's one of our best investments. We have also made bad investments when the market was low and then went higher. There's so many things that can work out between you and management, R&D, new products, distribution, processes, add-on acquisitions, cost reductions, EBITDA. That is just so much more important now. What you have to do when you invest that much capital is you don't levitate. You don't say, oh, the market's trading at 20 times revenue, so I'm going to go ahead and pay 20 times revenue. Because the business case just won't work on an EBITDA perspective based on that. What happens is that the industry is so giant in software. There's over 100,000 software companies. The market cap of software is $5 trillion today. It's mainly a fragmented industry. So even in really high markets, you have the opportunity to do 3 or 4 deals that make sense from your model and from what you're going to do operationally. So that is not where the market goes up and down and these crashes. We never levitated to that revenue multiple. And we also don't believe that 3 times revenue is right. And one of the things that has defined software since the beginning of time is pricing and efficiency. You look at companies that one day are worth $20 billion, and 6 months later, they're worth 3 or 4. Neither of those numbers could possibly be right in that short amount of time. What has changed in the business and with their customers in that amount of time? So we love to actually take advantage of some of these trends. But we'll see you in 5 years and see how it did.
Well, having said that, I mean, how much of the return that you've generated in recent years has come from multiple expansion? And having marked stuff up in the good years, how much are you now marking stuff down?
It's really impossible to look at that because most of our peers that do deals in software, and we're a pretty small group that does large cap software. We buy companies at a revenue multiple that are producing no earnings. So if you look at the earnings multiple, you may say you paid 7 times revenue, next year's revenue, but the earnings multiple was 100 times. Then we sell it 4 years later, like we just sold Frontline, for 18 times forward EBITDA. That would be multiple contraction. Huge contraction of multiple. But what we're trying to do is we're trying to turn a revenue multiple into an EBITDA multiple in 4 years. If mathematically we talk about it, if you buy it at 7 times revenue, and it grows roughly at 20 to 25%, and you produce a 40% EBITDA margin at the end from 0, you have turned that revenue multiple into an effective multiple at 7. The multiples that haven't changed very much are our exit multiples. So right now the market, if you divide up the software index and you just take out the profitable software stocks, which is only about 15% of the index, they're trading at 18 times forward EBITDA. That's about right. That's about a 27 PE versus the S&P 500. It grows at 3 times the rate. It's a better business model. Now, that number on average over the last 5 years has been 20 in the public markets. And it peaked at around 24 at the top. That is what our industry looks to sell companies at, to strategics and to each other and trade them in our community. Now, the unprofitable software companies, which is what we like to buy, because they're usually market leaders, very innovative, and could use some of our partnership and help. They went from 17 times revenue on average at the peak to 5 now. So there has been a big gap because finally investors say, I want profitability. You cannot be in an industry where your factors of production are greater always than your output. It doesn't work. And that's a big challenge that the public companies have today.
Well, on the subject of kind of public companies and their valuation, I mean, so software companies in particular in the public markets have been marked down pretty badly this year, as everyone will know already. And it seems as though in the private markets that hasn't happened to anywhere near the same extent. Like, how long can that discrepancy continue?
In private equity, our industry, and there's a difference between private equity, growth equity, and venture capital. In private equity, the marks are usually earnings, EBITDA. So you look at the comps each quarter, and you say, okay, they've gone down from 25 to 18, and you take a discount to that for illiquidity and other traditional reasons, and that's your mark. But those comps have not been very severe. So you won't see those markdowns if you have an EBITDA-based valuation, because then on top of that, you have growth, you have that pay down that helps you, and then you have a bit of the mark. So basically, peers of ours have left valuations, they're maybe down 5%, maybe 10%, some of them are flat. Venture capital and growth traditionally, right, uses the last round mark. That's more debatable. That's a bit of a problem because that last round probably won't happen in this market, and there's a lag effect to that.
I got you. Well, one of the other big trends, big themes for the software industry at the moment that's sort of hitting the software industry in a way more than other industries is the labour shortage and the talent shortage and the rising cost of employing people. How much are you seeing evidence of that hitting your portfolio companies right now?
That was, if you ask us what's your biggest problem, we have about 30 billion of revenue now coming from all of our software companies. And if you would ask us a year and a half ago, what's the biggest problem? Turnover. And the wage escalation, especially in Silicon Valley, that had been an issue to handle over the last, that huge inflation of your factor of production had been an issue for the last 10 years, since pretty much after the financial crisis. So that was nothing new. But the turnover rates right after COVID really spiked, even for companies that were based in areas where we used to have 5% turnover. Because now Google could tell them, just pick up your computer and work from home and nothing has to change in your life or where you live or where your family is. Now that rounds are getting a little tighter, that people are seeing that there's going to be a lack of capital potentially for the industry, that has slowed down quite a bit. There are other problems now. It's funny how quickly things change, right? Who would have thought that the biggest problem was going to be a big recession that could easily be coming a year and a half ago when you're worried about turnover and getting people? And that has shifted quite a bit.
Yeah. So to the extent that your business is about getting companies from, like you say, from a revenue multiple to an EBITDA multiple, which I think is, and tell me if I'm misunderstanding this, I think is kind of shorthand for you trying to tell us that you're making companies profitable when they weren't profitable before. That's kind of what you mean by that. How much of that, your ability to do that, is hit by the rising costs that are now affecting the business, the rising cost particularly of labour, which is, I imagine, the biggest cost?
So that rising cost of labor, what I was saying is, inflation is a problem in the world, but inflation for software companies where 90% of your cost is people,
Yeah.
and expensive people